Welcome to TheoTrade. This is Don Kaufman. It's March 30th, 2018. You are watching the Theo Weekend Update. It's nice. We've got a nice 3-day weekend here, a little bit of pause in some of the volatility. What I intend to do on this weekend's update is to really give you a bit of a feel of what my current game plan happens to be moving forward. You know, I mentioned this last weekend and a few times throughout the course of this past week within the TheoTrade chat room that I really feel at this point in time, the easier part of some of the volatility that we've been in is all but over. And what that effectively means is, you know, moving forward on a day-to-day basis, a week-to-week basis, we're going to be in some wild rallies, right? We're going to see some fairly wild sell-offs. Now, I don't mind giving you an opinion right up front. Overall, my longer duration bias right now is still absolutely to the short side. Again, I feel the markets are still going to continue to fall. There's going to be continued volatility. However, that is on a longer duration basis. At the exact same time that I'm saying with one hand, I'm going to maintain some short positions. And I'll even describe to you in a few minutes here, not only looking at the charts, again, exactly what that game plan happens to be. I'm going to show you which products I'm long, which products I'm short. And again, the game plan is going to involve not only the short duration, but I'm going to play this out a couple of weeks, even a few months out in time, and show you not only how I'm positioning myself, but how I'm going to be selling some premium against those particular positions. You see, over the last 2 to 3 weeks, I have had a lot of inventory on. Now, inventory to me means trades. Like, I look at this business as inventory management, right? You know, you want to be the Amazon, if you will, of trading, and that is, it's all about rolling over inventory. But right now, I'm extraordinarily light on inventory. We've taken off profitable trades on Intel, on Tesla, on Walmart, on Boeing, on Amazon, you know, Netflix and Cisco and Morgan Stanley. All of those trades I've just pulled off inside of the last 14 days. All right, so do I have positions left on right now? Absolutely. But most of the positions that I have on currently are much more what I would term duration positions. And what that implies is, you know, this is not about a week, it's not about the next month, it's, you know, 3 months or greater in horizon, okay? And those positions happen to be, you know, my Caterpillar position. I still have a position in XHB, which is the home builders. Again, I'll show you this in a few moments. I am still maintaining a position in XLF. Now, Caterpillar, XHB, XLF, I happen to be on the short side of the market. Do I ever have any long positions? Yeah, I've got some long positions right now in GE, where we've sold some puts and been put some stock, okay? Decent pricing, been rolling a lot there. Again, I'll display that. I've also got a small long position and I'm starting to build in ExxonMobil. But as I said, some of the easier part of the volatility. You know, what was the easier part of the volatility? All right, we're going to sell off pretty hard. I've got a lot of positions on. We're going to cover those positions, look for the bounce. But again, moving forward, it's going to be rather ambiguous when these bounces are going to come. You know, my inclination, okay, in just the next, you know, few weeks is that we're just going to bounce between major levels in the S&P. See, the S&P futures, they have tendency to trade in these tranches, right? Those tranches right now, the higher end of the tranche is 26.82 in the S&Ps. The middle of the tranche is 26.26. The lower end of that is 25.75. Obviously, and again, I'm going to show you this in the charts, but breaking above or below in those tranches is going to put us in a new kind of like, you know, area. We're going to have to establish new levels, and moving higher or lower is going to insinuate either a breakdown in the markets or a break up in the marketplace. However, again, in just this next, you know, short duration, I expect us to trade within those tranches, and that is what my game plan for the trade is going to be based around. Now, one other aspect I just want to take you through before we go into some of the charts is a little bit about the expected move. This last week, we just had 4 trading days. We're coming off 4 trading days. We had a $76 expected move in the SPX. That effectively means, based on option prices, the marketplace was supposed to move $76 higher or $76 lower. Okay? This is now the 4th time this year, on a week-to-week basis, it's the 4th time this year that we've now stayed inside of the expected move. So if you look back now, there are 13 weeks to this year, and we've been measuring an expected move pretty much on a Friday to Friday basis. Only 4 out of the last 13 weeks have we stayed inside of the expected move. Okay, so a $76 expected move in a 4-day window. Now, moving forward, that's this coming week. We'll show you in a moment. We have just over a $62 expected move. So volatility has actually contracted a little bit, which doesn't surprise us because we came off from yesterday, Thursday into the close on quite a strong rally. Again, I actually consider the rally that happened on Thursday, I think there's going to be some continuation to the upside, because in the short duration, you start looking at some of these underlyings, right? They have been beaten down, especially tech. So I expect a little bit of a bounce. However, at the exact same time, and again, I'll show you this in a moment, you're going to look at charts like in Boeing, you're going to start looking at charts, in a number of underlyings. So Boeing is a big one. Okay, Caterpillar is a big one. By the way, if you look at Boeing and Caterpillar, they're going to look ultimately the same. Pull out the duration to like 3 years, and you're going to realize we've just kind of skimmed the surface of the possibility of volatility. Now, last but definitely not least, moving forward, as I said, I see continued volatility. And one of the areas that I really want you to reflect on is, again, back to the fact that we have had 13 weeks this year, all right? Only 4 of those weeks has the marketplace itself stayed inside of the expected move, which if you look back historically, okay, this, again, we're going through like an unprecedented period, but the unprecedented period has to do with the fact that the marketplace itself, like the SPX, is moving substantially more, right, than is implied. So we're talking about historical volatility, okay, or actual price movement is significantly more than the option premium is forecasting, okay? And it's one of the reasons I believe that we're going to have to go through, and I'm reiterating this from, again, some previous videos, I believe that we're going to have to go through another very considerable volatility shock. And what that effectively means is, well, it sounds just like it sounds, right? A little bit of shock, a little bit of awe inside of the markets. Now, when that volatility shock is going to come, or what's going to cause, like what's the catalyst, people, that's up for grabs. You have to realize, though, that moving forward in this marketplace now, okay, this is no more cakewalk. You're either going to be trading some options, you're going to be selling some premium, you're going to be buying some premium, or you're going to have to establish a long-short portfolio. Don't tell me that you're just going to be able to get long stocks for the next couple of years and it's going to be a cakewalk. Listen, you got the Fed going against you. You got volatility that's starting to rage. We're looking at staring down the face of regulation of the tech industry. Okay, there's a lot of headwinds facing this market. With that, let's get to the charts. All right, let's start with the S&P futures. And one of the reasons I like to start with the S&P futures, even though everybody's looking at the Nasdaq marketplace, which is in a bit of turmoil this last week, I think that would be to say the least, you still have the S&P futures that are ultimately driving the bus out there. And what you happen to be looking at right now is none other than, this is just a 30-day, 1-hour chart. So it includes overnight trading. And the reason I like to bring up this time frame, the 30-day, 1 hour, it shows how nicely and how cleanly we're just pinging back and forth between our associated levels. Now, again, we just kind of mentioned a few of these levels just a moment ago, but I will script them once again for those of you who did not catch it. Here we have 26.82, right? 26.26, and down below over here, we're looking at 25.75. So those are your effective levels that right now we just expect us to ping in between. So what do I really anticipate? Again, in the short duration, okay, in the short duration, you got to realize that when you get in a more volatile market situation, it's going to be much more difficult to really predict anything. And we're not trying to make a prediction. All we're trying to do is kind of give us our best foot forward in the marketplace. What I anticipate early next week, again, barring any unforeseen circumstances, we're one tweet away from a 100-point drop in the S&Ps. As I said, in the short duration, I expect us to actually ping back to the upside. We may even get as far, again, as that 26, all right, 82. Coming over to the 26.82, if we peak above it, all right, eventually we'll come right back down to the 26.26 and even test 25.75 and below. So I want to make something clear. In the very short duration, I still expect a bit of a bounce. Now, I want to show you that on and really looking at a couple of equity products. Okay, so you start to look at aspects like Facebook. All right, Facebook is a little bit of a one-off because there's just been tremendous media coverage around this, but Facebook could still have some room to bounce to the upside. When you start looking at Google, all right, let's look at this on a year-to-date percentage. And I want to rip through a couple of these fast, right? This thing was up basically 10%. All right, then was down almost 10%. To see a bounce back, the bounce has been so mild. It's still down, 3% year to date. But from high to low, all right, this sell side activity is fairly dramatic. So to see a bounce, to come back up here, right, would not surprise me at all. And then, and only then, in the short duration, I'm going to step back in and I'm going to short a couple of these. How am I going to short them? Using defined risk spreads. So now what I'm trying to do is to bring you into a little bit of the game plan. And the game plan is simply this, right? I am going to be maintaining some short positions in the marketplace. But the short positions that I am going to maintain, all right, in those equity products, they're longer duration positions. And I want to make something clear. I am going to remain short inside of Caterpillar. How am I going to remain short in Caterpillar? I have already purchased, all right, I'm going to zoom out in time here. I've already purchased an in-the-money put. Now, when I say of a duration position, I expect to be short Caterpillar more than 3 months. Now, I've been short Caterpillar, okay, from almost the beginning of the year. So, a whoop-de-doo to the upside, some pretty good sell-side activity. All right, once, twice, maybe the third time's the charm over here in Caterpillar. What I'm referencing is the ability for Caterpillar to ultimately break lower. Nevertheless, I remain, okay, in a longer duration short position, even if I think that in the short duration, we may still pop to the upside. Longer duration, again, out in time, I think Caterpillar is a good short stance. In addition to it, I am going to maintain a short position in Boeing. I told you, Boeing and Caterpillar, kind of like two peas in a pod here. If you looked at the chart and I snap from one chart to the other, you literally can barely tell the difference. When you're looking at Caterpillar, though, and Boeing, you have to look at, from a perspective, technology's been beaten up a little bit. Caterpillar and Boeing, they looked pretty ugly a few weeks ago, but right now, this is mild. And when you start coming out on a longer duration, just pull up like a 3-year weekly, people, that is awe-inspiring. I mean, you got to look at this and think to yourself, oh yeah, I get what he's saying right now. That's why this is a longer duration short position. In Boeing, again, I'm using a deeper in the money put. This is stuff that I've explained in numerous times in the TheoTrade chat room. Again, even in the short duration, if I think we're going to pop, maybe we pop back, as far as 340, maybe 345 inside of Boeing. But people, there's no question in my mind over here. This thing, it's a long way down. And that's why I'm going to maintain those short positions. Now, in addition to, Caterpillar, Boeing, what else am I maintaining a short position in? Okay, a short position in the XHB. So the XHB has gotten whacked back a little bit, but here's where it's kind of confusing to people. I'm longer duration short. So don't confuse that with short duration short. Now, these are for duration. And what I intend to do, again, part of this game plan is, so I'll buy an in-the-money put. Why buy an in-the-money put? Okay, what does that signify? Like, all right, we can look over at Morgan Stanley, because Morgan Stanley is another one where I'm actually considering building a longer duration position in. All right, so let me just close up this left side bar and explain this in a bit more detail. Let's come out, for example, to May, and there's 49 days left in May. And I have the ability to just look 49 days out in time. I'm going to cruise right down into the delta, and I'm going to look to find an option that's trading usually over about an 85 delta. So here's a 60 put. Now, what that effectively does by buying an in-the-money put, all right, giving myself like over an 85 delta, it gives me about 85 cents bang for my buck for every $1 move inside of Morgan Stanley. So it's a way to get, number one, you can get short, and you can get short in an IRA. Because, these days I've been trading in an IRA. I'm getting up there in the years now, talking mid-40s here. Anyway, getting up there in the years, and I'm trading almost exclusively in an IRA because my accountant says, you should trade in an IRA. All right, so I buy this put that's in the money because you can't get short stock inside of the IRA. And me, I like to get short stock. And effectively, that gives me a lot of bang for my buck for the next 49 days without having to substantiate inordinate risks. Let's say there is an explosive rally. What, you ever been wrong on the market before? If there's an explosive rally, you know, your risk is mitigated to even less than $6.50 because there'd still be some time left in here. But once you've then purchased that put for the next 49 days, if the market starts to fall, you have the ability then to take the put, all right, to sell it, and then to turn around and buy one further out in time, again, continuing this plus 85 delta. In addition to it, using an in-the-money put and simulating stock gives me the ability also to sell shorter duration options premium against it. So when I talk about my, the game plan, all right, here's the game plan, and I'm going to kind of script it out for you a little bit. So I'm going to maintain an overall short, delta, that's delta, bias. So I'm short delta bias, which basically means I'm short. What am I short? Again, currently short Caterpillar. I've got a position inside of Boeing. I do have a position in the XLF, and I'm looking to build a position specifically in Morgan Stanley. All right, these two positions are kind of peas in the pod, but nevertheless, I want to maintain that short position, and I need a little bit more short delta bias. Okay, I do have a couple of long positions. Those long positions happen to be GE, which is mild, and very mild, which is ExxonMobil. Those are long. And again, this is all what I term duration stuff. So a short delta bias, is 3 months, plus. I have every intention of holding the short delta bias for 3 months plus. All right. Now, went through a couple of the short positions, and I have the ability to sell some premium against those short positions. Now, in the short duration, here's what I'm going to do in the short duration, and this is where I've pulled off a lot of positions. I'm looking at everything where I've actually pulled off positions, in Netflix. I was bearish in Netflix. We pulled off the bearish position, no problem. I'm waiting for a little bit more of a bounce. We're probably going to have to get through the earnings before I'm ready to re-up in there. Nevertheless, whether it's Netflix, whether it's Apple, whether it's Microsoft, in all of these products, all I'm doing is hunting for the bounce, and I'll re-up in a short. Now, when I'm looking for a short position in something like Tesla, this is going to be completely different. I'm not going to be buying an in-the-money put in a Tesla. You buy an in-the-money put, look at this. In May, 49 days out, that's only a 72 delta put. Thing's trading for 37 bucks. You know how many strikes you're going to have to open? You're going to have to open all of them to get to like an 85 delta. Look at this. These puts, they're almost 50 bucks. There's no way inside of Tesla that I want to take that amount of risk. So what I'm effectively going to do when I'm ready to re-up and to put some short positions on, I'm just going to use some in-out spreads. I'm not going to get cute. I'm going to go out there and I'm going to use some very defined risk trades, and take my short positions and let the volatility, eventually crush the market. That's what I anticipate. So when you're looking at something like Tesla or any of the tech products that you might want to short, listen, their volatility right now is just jacked up. It's through the roof. Go look at something like Netflix. Netflix volatility is 45, 48%. Clearly, there's an earnings announcement coming. But even in the next 2 weeks, 48% volatility, you're looking at like a $23 expected move. That you got to put on your big boy pants for. And I don't want to take inordinate amount of risk. When I say I want to put on like a short duration position, look, here's a $5 wide spread for $2.35. Yeah, it's a little bit bearish. So again, that happens to be a bit of the game, the game plan over here. And I'll go into much more extent, throughout the course of the week on a number of the chat sessions that I do live. Again, I still try to do at least 7 hours per week live in the chat room to be able to go into much more depth about each and every one of these positions. I'll also talk a little bit more about the XLF position I've got on. Again, I have an XLF position. You can see I'm 77 days out. My position's right here. I am long. I own the 33 puts, which then affords me the opportunity, if the market sells off, I'm actually going to sell some shorter duration puts against the long duration put. Why? I don't know. Could sell some premium out there. So right now, I have to tell you, I am grossly under allocated. I took off, again, lots of profitable positions in the near term. What I'm looking to do is to reallocate. Before I start to really reallocate, I want to see if this marketplace is going to bounce. Listen, I've already got those short positions on. If the market falls, we're positioned well. Nevertheless, a bounce will give me more opportunity at that point to kind of re-up a few shorts. And I know that a lot of people are like me, right, out there in the professional trading arena. They're waiting for the exact same thing, all right? It's, they'll bounce the S&Ps. So what we're looking for is cover, bounce the S&Ps, reload, and take them back down. But I also find myself in like a little bit of a catch-22. I'm talking to some other traders. They're thinking the same things. They're waiting for the bounce and then a reload into short, which again leaves the market in a little bit of a lurch. It leaves us like this ambiguous feeling, at least to me, where we could head right back down coming into early next week. You got to realize, again, this is a highly, motivated, news-driven market all of a sudden. We were saying a few months ago, markets don't pay attention to news. They don't pay attention to anything anymore. Now, we're one tweet away from 50 points higher or lower in the S&Ps. Last, but definitely not least, let's talk about 50 points higher or lower. What I wanted you to see is what I started the conversation with, and that conversation happens to be the expected moves. As I said, we've now passed through a total, here's 13 individual weeks, of which, again, we only have 4 of those 13 weeks that we've stayed inside the expected move. This last week, which is right here, this last week, again, we stayed inside the expected move. Now, it's no wonder we had a very large expected move of $76 for 4 trading days. It's no wonder now the volatility is contracted again. And the volatility sits right at about plus or minus about $62. That's what the volatility is going to give us in terms of movement. So now that we're $62 for a 5-day move, once again, we could see the expected move exceeded. Now, when you're seeing statistics being broken this much, I'll leave you with this thought. A volatility shock could come at any time. What that volatility shock is likely to do, and why I believe a volatility shock is going to come. People are like, that was a volatility shock back here in February. No. It didn't scare the markets enough. We have to get a volatility shock so gruesome, so hideous, that the implied volatility of the marketplace doesn't snap back. That the market-making firms, every trader, they get so scared that the volatility stays high for a substantial period of time. We're not going to get a quick reversion to the mean back. Right? We need a move so terrifying that it'll make you think twice about ever wanting to sell option premium. That's the kind of move that'll take this marketplace. And again, the marketplace right now is rather inefficient. To become efficient again, where implied volatility is getting better at dictating the moves, to get efficient, we need to get scared. Thanks everybody for joining us here at TheoTrade. Enjoy the holiday weekend. Bye-bye.